Hello, this video is to introduce Chapter 7, which is the chapter we'll be looking at in week 4. The topic is cost value profit analysis. This is a topic where we learn how the company tends to forecast their profit level and to also forecast how long or how many units of goods they need to sell in order to start making profits, whether they calculate it in physical units or they calculate it in $6. And the other aspect is we look at the company cost structure on this topic as well and how that affects the company profitability. I will recommend that you take a look at the learning objectives on D2L or your textbook to understand the specific areas we focus on this topic. But I will be giving an introduction to the topic by highlighting the following points. So the first part or the first objective is you understanding the concept of break-even point. For those that are not from accounting background, it is a point in which a company do not make profit nor loss. Break-even points typically will look at the company's fixed revenue minus the variable cost. And what you have after that is what we call the contribution margin. Now, you could calculate this as a whole, which means you could look at the total number of units the company sells multiplied by the sales price per unit. And then you look at the variable cost per unit multiplied by the total number of units that the company planned to sell or budgeted to sell. And then you get the total variable cost that is forecast or budgeted. And then the difference between the two will give you the contribution margin. The other way to calculate this is looking at the selling price. If you are looking at contribution margin per unit, that is a short form. You basically look at the selling price minus the variable cost per unit, and then the difference, you multiply, you use that to times the number of units to sell. That basically gives you the value of contribution margin per unit. Now, when you get your contribution margin per unit, for you to know your break-even point of for you to break even in a business, you need to neither make a net profit or net loss. So in that case, it means your contribution margin covers your fixed expenses. So right here, we have the fixed expenses, or we call it the fixed cost. So the fixed expenses here is $100,000, and then your contribution margin is $100,000, which means the contribution margin covers the fixed cost or the fixed expenses. At this point, you neither make profit nor loss. It is important to take note that the fixed expenses here will basically include fixed expenses for everything, ideally different from what you call the fixed asset or whatever that may be, or in terms of manufacturing business, what you might call the fixed manufacturing cost. We're looking at the fixed expenses, whether period cost or product cost. So to put it in a short form, companies' expenses are either variable or fixed. So that's just the way to put it. And of course, this contribution margin we look at here focuses more on the variable expenses here, focus more on the variable aspect. Now, we could say that this difference here between these two is 0. Now, the contribution margin ratio, that is, we just understand the concept of contribution margin. Contribution margin can be calculated as units, which means the number of units you have to sell, and in ratio. So the contribution margin ratio is basically your contribution margin divided by your sales price, by your sales. What that basically means is, what is the percentage of your contribution margin given your sales revenue? And then that gives you this contribution margin ratio. When you get your contribution margin ratio, that can be used to divide the fixed cost to get the total sales amount that you need to you need to sell in dollar in order to break even. So this contribution margin ratio we have here could be brought here, which is going to be fixed expenses divided by the contribution margin equals to the break-even point in $6, which means the amount of sales revenue that you must generate in order to break even. Here's another example. We could say in this example that the sales for this company, the softboards is 400 units. And then you less the contribution margin. So basically 400 units multiplied by the selling price is $200,000. And then the variable expenses is $300 per unit. $300 per unit multiplied by the 400 softbox that was sold, that is going to give you $120,000 as the total cost for the variable cost. And then the fixed cost is fixed. Right here, we could see that the fixed cost is 80,000, and then the contribution margin is 80,000 as well. So when we minus the fixed cost from the contribution margin, the net income is zero. At this point, we'll say the company break even. In other words, at sales revenue of $200,000, the company will break even. This is important information if you were to set a target for your sales team, or to drive a campaign, or carry out an analysis to be able to forecast how much you must sell in order to break even. You must sell at this amount in order to break even. Given that, you know what the variable cost per unit is, and then you know what the selling price is. You could always forecast how much needs to be sold in order to break even. Now, we could also do it in a different way. Right here, we know the price per unit, $500, and then the variable cost per unit is $300, and then the contribution margin per unit is $200. With this $200 we just calculated, which is the contribution margin, we can calculate the number of units that must be sold in order to break even. To do that, you need to know your fixed cost. Your fixed cost is 80,000. Your contribution margin per unit is $200. Now, if you divide 80,000 by $200, that is going to give you 400 softboards that must be sold in order to break even. So your break even in units is going to be 400 softbox. So in some cases, you might not have information about this total amount, or you could be given information about the selling price and then the variable cost per unit, and then the fixed cost. Those three information is enough for you to calculate your break-even point. Or you could be given contribution margin and then the total fixed cost. And then with these two information, you can calculate your break-even point in units. And we could also look at it from different aspects. If we look at the subboard 100%, and the variable cost out of this, we look at the variable cost, say 300 divided by 500, that is 60% of the selling price. In other words, 120,000 divided by 200,000. So that will give you 60%. And now, if you know this percentage of the variable cost given the sales revenue, you could calculate the contribution margin in percentage as well. So which is 40% in this case. With this 40%, you can calculate what is the break-even point in dollars. So what you simply need to do, just like what we did earlier, you have the fixed cost. Okay, you have the fixed cost $80,000 divided by the contribution margin ratio, which is this 40%. And then you have $200. What that means is at this $60, the company will break even. So there are multiple ways in which you can calculate your break-even point in $60 and also break-even point in 6 units. Here is a cost value profit analysis graph. Now, your fixed costs remain constant, assuming that the number we have here, we plug into the graph, your fixed costs will remain constant within the relevant range. Let's say the maximum the company can produce at the maximum capacity that company plant can produce is 800 or 800,000. Now, the fixed cost is constant within that range, and that is one of the assumptions in cost value profit analysis. If beyond 800 units, the company will need to expand their capacity, then the assumption for cost value profit analysis is violated. In that situation, we can't use the cost value profit analysis, given that the fixed cost is not constant. So in this case of our forecast, we believe that the fixed cost won't change so long we are producing between 100 and 800 units. However, the variable cost will change as the number of units we produce increases. So the variable cost here, which is the blue line, which is the red line you see here, you could say that it continues to increase as the volume of our production increases from 0 points to 800 points, okay? Which means at the point of 0 here, if we do not produce anything, we will still incur fixed costs of $80,000, just like what we had earlier. Whether we produce or not, we still incur that fixed cost because it's fixed cost, or sometimes it's a committed cost. But the variable cost will only start increasing as we continue to produce from 0 points, and then we increase the number of units through the graph, and then this red line here will increase proportionally. And as the $6 increases, as we produce more, we will generate more contribution margin to cover the fixed costs. And once we cover the fixed costs, we'll also be able to cover the variable cost. And at a point, we cover all the fixed costs, we'll cross this fixed cost line, which is the first line in the bottom, and then we will also cover eventually all the variable costs and even exceed that variable cost. At this point in which we cover both the fixed costs and the variable costs, we will break even at this point. This point here will be a point in which you neither make profit nor loss. And as the contribution margin continue to come in because we sell more, that will result in profit. And this is what you could see in this graph between the red line and the blue line as the profit, as the net profit after the fixed cost and the variable cost is covered. Now, right here is your sales in dollar. So we can see here the sales in dollar continue to go up. Now, the target net profit. The target net profit can be forecasted if we are told that this is what the company wish to make as a profit. Then we could, as a marketing manager or as a business manager, you could use that information for the fixed cost plus the target profit divided by the contribution margin to forecast how many units of products you need to sell in order to start making profit. In this example here, we know the fixed cost to be $80,000, and we know that the company wishes to make profit of $100,000. Perhaps that is what they promise their shareholders. And then the contribution margin, we know that what that is, given the calculation we did earlier, contribution margin per unit. With this information, we know that the company must sell 900 softbox in order to start making, in order to achieve this target profit. Anything less than the 900 softbox may not result in this 100,000 target profits. So when you make a budget in a year and you already know the fixed cost and how many capacity the company can produce, you know the variable cost, you could always tell the marketing manager, we must meet this target in order for us to, we must set this number of units in order to, for us to achieve our target profit for the year. Now, here is an equation that could be applied to the calculation of break-even point in units. In this example here, we know that our selling price was $500. And right here, we know that we don't know what our S is at this stage. And then right here, we know what the variable cost is. Again, we don't know what the S is. And then we know what the fixed cost is. And we expect to make a profit of 100,000 softbox. Now that we know this, what is 2 is, but we don't know what the S is, we could literally find that information out by solving for S, which in this case is going to be this 180,000 dollars, which is a combination of the fixed cost plus the target profit divided by 200, which is going to give us 900. So given that we know this information and we also know this information, which is the contribution margin, we can solve for S, and S is equals to $900. Now, the safety of margin is another calculation that is included in the profit and loss analysis. What this basically means, as the word suggests, is a safety of margin. It is a calculation or analysis to determine how safe the company is in terms of profitability. The essence of calculating the safety of margin is to determine how much the company revenue would need to decline for before they start making losses, or how many units that the company must sell less for them to start making losses. To calculate the margin of safety is relatively an easy process. So let's assume that this company has a break-even point of $200,000 in sales. If actual sales are $250,000, the margin of safety is basically $50,000, which is $250,000 the actual sales minus the break-even point in sales. Because at this amount of $200,000, the company will cover their variable cost and their fixed cost. So if they are currently selling $250,000 as their current sales, it means that their sales will need to decline by $50,000 or decrease by $50,000 before they start making losses. Or perhaps just divide this $50,000 by the sales price, which we calculated earlier, divided by 500. That will give you 500 units. That means the sales in unit needs to decline or decrease by 100 units before they can start making losses. Now, let's look at multiple products. So the method we have talked about so far basically focus on a single product. In some cases, the company could be producing multiple products. What that means, it has a better chance of break even earlier than single products, because each of these products they sell will have different level of contribution margin. So that is the example we're going to look at now, what we call a sales mix. A sales mix is when multiple products are simultaneously sold by the company, whether sold jointly or sold separately, but basically they put into consideration all of these products that they have to sell in the year in order to estimate at what point they have to break even. Now, let's assume that this company called Incorporated sells softboard and distilboards, and see how we deal with the break-even analysis. Now, in this example here, let's assume that the selling price for the softboards is 500, as we looked at earlier. For the sales board is $1,000, and then the variable cost for the softboards is $300, as we did earlier, and then for the sales board is $450, which means the contribution margin for the softboard is $200 and the sales board is $550. And then what they are estimated to sell in terms of the number to break even is 500 units of sub-bulks, and the sub-bulks is 300 units. That means the company must sell a total of 800 units for both products. This is not by any way what we are trying to consider as the break-even point yet in terms of the sales mix. But if we look at it for individual products, they will need to sell this amount to break even. And now we have to move forward to estimate what they will need to sell in terms of the number of units if they are selling these two products simultaneously in order for them to break even. Might not be up to 800 units. So if the number of softboard to break even for this product is 500 units, and then for the sales board is 300 units, the total is 800, which makes that the contribution from the sales board towards the joint sales or the sales mix should be 62.5% of the total sales units. And for the sales board, it should be 37.5% for the total sales units. So basically, we'll have 500 divided by 800 to get this proportion that the company must sell for the softboard. And then we will need to divide this 300 boards by the total board they need to sell to get the proportion for the sales board. And now the contribution margin for each of the products, $200 and $550 respectively. If you remember, we did calculate those contribution margin here earlier. Okay, so now if you look at the amount that must be contributed for each unit of the soap box that was sold, if we are dealing with sales mix, we're going to sell these two products together, then this must contribute 62.5%, because that was the percentage of the quantity that they have to have in the sales mix for this company to break even, and also for the sales board. So 62.5%, and for the sales board, they will need to have a contribution of 37.5% from the contribution margin from each of the products, which is the percentage we calculated here earlier. And that is going to result to $125 for the softboard and $206.25 for the sales board. So combined would be $331.25. Okay, so that is the same as the calculation we did here earlier in this proportion here. Now, the next thing we want to find out is what is the break-even point if we are dealing with sales mates. As I said, it's not going to be the 800 units, because this 800 units is assumed that we're selling these products individually. But if we are doing it 6 weeks combining these two products, how much must we sell to break even? So given the estimation we've done so far, we have to calculate what is the company total fixed cost for both products. When we know the company total fixed cost, we'll divide it by the joint contribution margin for both products, which is $331.25. That will give you 514 units that must be sold by both, that must be sold jointly from the two products, which is the softboard and the salesboard combined. The company must sell 514 units as in the 6 mix. Now the question is, how many of these 114 units must be sold for the softboards, and how many of these 140 units must be sold for the salesboards? So again, you take a proportion of what you have here, 62.5% of that 514 units that must be included in the 6 mix, and then 37.5% that must be included in the 6 mix in order to be able to break even. Okay, so what does this indicate? It means that the company can break even early if they combine both unit products and sell them together as a 6 mix, as compared to selling each of the products, like what we see here earlier at the beginning, where the company will need to sell 500 for the softboards and 300 for the salesboard to break even. So basically, this is what I explained previously. So for the softboards, they will need to have 321 units or softboards in the 6 mix and 193 units for the salesboards, at least for them to break even. Now here are the assumptions for the cost value profit analytics. I have mentioned some of these assumptions earlier. The fixed cost has to remain constant within the relevant range. The selling price is also constant throughout. The selling price cannot vary. The selling price change that will affect the number of units to sell in order to break even. Let's say, for example, you offer a discount that will affect the break even units and also sales in dollars. Costs are linear over the relevant range, which means the variability of cost is linear within the relevant range. So the relevant range is what I explained in the graph earlier, which is between the 0 points and then the 800 units that must be sold, okay, to the relevant range. The other thing is in multiple product companies, the 6 mix is constant. In manufacturing firms, inventory do not change. So they must have adequate inventory for them to achieve that break-even point. Now, the cost structure does affect profitability. Cost structure basically look at what is the dominant cost for the company. Is the company total cost or large proportion of the company's total cost variable cost or fixed cost? That matters because that affects how profitable the business is going to be. If you look at the cost structure for businesses, it's quite an interesting part because it has both costs and benefits. In the long run, especially for mass production company, they could be better off if they invest in equipment whereby they have so much fixed costs in equipment, building, facility, automation, and all of that, which means that they have to bear that cost every single year, whether they produce or not. If they have variable cost, that cost can vary over time. And if they produce more, the cost will go up. If they produce less, the cost will go down. But the interesting about the variable cost is it's avoidable cost in most cases. Like during the COVID-19, when there was lockdown, what most companies did is basically lay off staff. They don't have to pay staff during that time. That labor cost is saved. But a company that invested so much in equipment during that COVID-19 lockdown, if they take loan to invest in that equipment, they'll continue to pay that loan to the company that they take the loan from. And also, if some of those equipment have useful life, whether you use it or not, because of the materials used, that the product has to be disposed, they'll still continue to depreciate it, which means they continue to bear that fixed cost. So that has significant impact on their profitability as well. The interesting part of this cost structure is companies that invest in fixed assets, they could maximize the units they produced. And even though they say a certain number of units, the fixed cost will remain the same, but the profit will go up if they have less variable costs. So there are costs and benefits to this. I'm just going to quickly explain how you calculate the operating leverage. In this example here, the sales amount is 250,000 units, $250,000 for the softboard we looked at earlier at 500 softboard. And then the variable cost 150,000 units, and then the contribution margin is 100,000 minus the fixed cost, you have a net profit of 200,000. So to calculate your operating leverage, it is your contribution margin divided by your net income. Okay, so your net income in this case, your contribution margin in this case, which is $500, is 5 times of the net income. That is important. Why? Because any change in the sales volume by 1 unit will result in net income increasing by 5-fold. It's the opposite too. Any 5-fold increase in the net profit will result to a unit change in the sales volume. So as you achieve a marginal increase in your sales, in the number of in the amount of sales, that will result in your profitability by 5. This is important for many analysts who want to see how well or how profitable a company is. And this amount, whether it increases your profit or not, depends on your fixed cost, whether most of your cost is concentrated as fixed cost or variable cost. If you look at this company, for instance, most of the cost is concentrated in variable cost. Just 80,000 is the fixed cost. If you want to play around with this number and perhaps switch these numbers around and then replace the fixed cost as 150,000 and then replace the variable cost to be 80,000, you will say that the profit can actually significantly increase given a unit change in the sales volume. Okay, so this is very important information. So to calculate how well or how, let's look at this example. Say the operating leverage is a measure of how a percentage change in sales value in sales will affect a profit. If coal increases its sales by 10%, what would be the impact on the net income? So to calculate the impact on the net income is basically the operating leverage multiplied by the change in the sales volume. In the sales volume, we have here is 10% multiplied by the operating leverage. That is going to be 50% increase in the company's profits. So that is where I'm going to stop on this topic, and there are more to learn on this topic. It's quite interesting, especially for those of you currently working as managers. You will find some insights from this chapter that you can implement right away in your work breaks.